So, after you reach a certain income level and after you have funds saved up beyond your emergency fund, you should actually start investing. And interest upon interest compounds, and you're going to see a greater return on your money than if you would have it saved in the bank. Guys, welcome to my channel. My name's Howie. I talk about everything related to finance, personal development, and business. And if you like that kind of stuff, don't forget to click and subscribe to get updated on new content like this that's going to help you and your life. Okay, so let's get into it. So let me talk about my personal journey. I started my own company over 15 plus years ago. And initially what I did is I did not have enough funds to make the business keep going. Even though I was doing well and gaining profits and revenues, any excess money, I wasn't really investing those assets. I was just leaving it in the bank. And the fact of the matter is you're earning 0% interest on that money at the bank. You're not earning, it's not doing anything for you. You're not getting any kind of benefit for it. And after a couple years, I realized, this is not benefiting me in any way in terms of appreciation. It's not helping me increase my capital or income, and I'm not getting any residual benefits by having just sit in the bank. And then I realized that if I take that money and I invest it in interest-bearing funds or interest-bearing securities, those types of instruments that's going to give me some kind of return on my cash, I realized, at least that I can get a percentage, 5, 10% or higher on my cash rather than sitting in the bank. So it's after that, a couple years, I started investing. And this is through my own personal company, but you can do this individually. I took the cash from my revenues, my sales revenues, and I actually put that or parked it into a corporate account for securities. And then those securities were invested in companies in the high-tech growth sector, in mutual funds, and those types of investments. Lo and behold, a couple years later, I was making, 100,000, 200,000. This kind of cash flow, not from me doing any kind of sales activities or having to go out to close deals or to make cash, although I was doing it at the same time. But this was cash on cash. That was interest accruing from the investments, either through dividend income through the stocks and or just through the appreciation from the companies that were doing well. So let's actually think about it in terms of what you're doing if you're investing in stocks. What you're essentially doing is you are an investor in the company. You are part of the company because you're investing your hard-earned cash into their company, assuming that it's going to appreciate and do well in the future. And most times it will if you do your due diligence on the type of company that you're investing in. So that's one reason why you should invest. So we're talking about after you reach a certain threshold. Let's get back to the point, which is there's a common theme or common kind of general knowledge that out of your monthly paycheck, now let's talk about the individual. Out of your monthly paycheck, let's say you're getting paid $5,000 per month. 60% of that $5,000 should go to pay your necessities or things that you need to take care of, your non-negotiables. And that would be like if you own a house, a mortgage expense, rent, utilities, food, things that you need to sustain your life and to keep your life going should be 60%. 20% or a little greater thereof should be put into expenses that you don't necessarily need that aren't going to sustain your life, but that are going to enrich or enhance your life. And that could be purchasing books, going out to movies, going out to trips, those sorts of activities. And then the last percentages should be put into an investment. Now, whether you choose to put that into a tax-deductible account or a Roth IRA, or actually investing in the market, that percentage is going to accumulate, and that's a set percentage or set amount that you're investing every month, every month, every month. And by the power of compound interest, you'll see that your investments will increase, over the years. Instead of having $0 in your savings account or $0 from investing in a bank, you're going to have money from the percentage return on your mutual fund or individual stock. If you were to invest, for example, like $1,000 or so 10 or 20 years ago in a stock like Costco, you would have tens of thousands to $100,000 or more return in your bank just from investing in the stock. Now, why is that? Well, you're investing in a company that has, is a market leader in its particular retail space, which is retail sector. Company is outstanding in terms of the business services they provide, the company management, the fact that they're strategically growing, the fact that there's the same type of foot traffic and increase foot traffic to their stores and increase revenue and to their bottom line. And that is going to increase the overall profitability and outlook for the company and increase your share price and increase your money. Stocks are one way to go. Another way to go is obviously real estate, investing in real estate, either as an investor where you buy a property through a mortgage and you put down payment and then rent it out and then have the renters pay that, or you actually buy the house outright and hold it. There's different vehicles or different ways that you can invest in real estate. Real estate is a long-term play. Some say it's a good kind of balance to having stocks because it's more stable. However, it's less liquid, obviously, than cash or stocks where you can't take it out immediately. But it's a long-term play. And there are other investments that you can get involved in the market. Some are a little more riskier, like cryptocurrency, gold, or those types of investment vehicles. But it's better than not investing, period. So the message that I'm trying to kind of relay to you out in the world is it's good to save. It's good to have an emergency fund. And before you invest, I would recommend that one is you pay down all your debt. Two is you have an emergency fund for a rainy day. Let's say you lose your job or you're incapacitated for some reason, there's some type of emergency. You should have a 6 to 12 month kind of time period or a money sacked away that where it can be used as an emergency fund for those types of things that you can't plan for and that happen. And after you have achieved that, then any amount in excess of that, invest in the market, invest in money that's going to give you a return on your money rather than having it sit in the bank. Anyway, that's kind of my video today on why you need to start investing your cash and not keeping it in a market which is just plain dumb, in the bank which is plain dumb, earning zero interest. Thanks so much for joining the video. Appreciate it. Don't forget to click and subscribe, and I'll see you on the next video. Look forward to you on the next one. Take care.